What's kind of unique now is that ever since the invention of Bitcoin and then extended it into things like stable coins and so forth, is that for the first time you can, do actual settlement, not just transactions, but settlements of value. And so, you can transfer value to someone without going through centralized ledgers. You can go around existing banking systems, around existing capital controls, peer to peer rather than institution to institution on behalf of peers. And so that just dramatically kind of realigns what the power structures are. But of course, even then, it takes time. I mean, it doesn't matter until liquidity and size is big enough, which takes years of kind of slow grassroots type adoption.
As traditional currencies face the threat of devaluation due to rising inflation and excessive issuance of fiat currencies, investors are contemplating whether now is the time to incorporate cryptocurrency into their investment portfolios. Lyn Alden, an investment strategist renowned for her multidisciplinary expertise in engineering, technology, and finance, emphasizes that Bitcoin's utility extends beyond its conventional role as an investment instrument. Bitcoin's uptick by more than 15% this week has caused the asset to hit new all-time highs against several depreciating fiat currencies. With the leading cryptocurrency recording new highs against the Argentine peso, the Japanese yen, the Turkish lira, and the Nigerian naira, anticipation is rising about when it will register an all-time highs against the United States dollar. Alden indicates that the growth of decentralized digital assets offers people alternatives to their local currencies, challenging the current norms. El Salvador has officially recognized Bitcoin as a legal tender and has legalized the use of all digital assets for payments. Argentina, led by its new president Javier Milei, is anticipated to adopt a crypto-friendly stance despite Milei's fluctuating views on Bitcoin. Venezuela has established a legal framework acknowledging cryptocurrencies as payment methods. At the same time, Brazil has passed legislation to legalize crypto payments and boasts the highest number of crypto ETFs traded on its national stock exchange. Furthermore, on February 16, 2024, the Japanese cabinet endorsed the inclusion of cryptocurrencies among the assets permitted for acquisition or holding by local investment limited partnership firms. Lyn Alden underscores that although governments and central banks predominantly regulate access to foreign currencies like the US dollar, the emergence of technologies like Bitcoin and stablecoins offers alternatives to traditional banking systems. Let's delve into the video to gain further insights. Before we begin, consider subscribing to the channel and hitting the bell icon to stay updated with the latest content.
160 different currency monopolies. And the reason they exist is because of the technological limitations that got them there, right? So for example, let's say you're in a country, maybe it's Nigeria. And you think, okay, how does money get in or out of Nigeria? There's really two main ways. One is physical ports of entry, so bringing physical currency or gold coins through a border, through an airport, which is obviously tightly controlled, easily to enforce. You see signs every time you go through an airport. You can't bring more than $10,000, for example. And then the other way is bank transfers. But of course, banks are highly regulated, centralized, kind of governed institutions. So there's all sorts of rules. Who can they transfer to? And also who can have access to, currency in a given unit. So if I'm in Nigeria and I want dollars, if I want a dollar-based banking account, it's kind of the government and the central bank's choice if that's even an option to me. And if so, how safe is it? Because this is basically an unlevered dollar bond fund with no direct access to the Fed or FDIC insurance, even if I am allowed to access it or if I'm wealthy enough to access it. For example, some of these countries, you can only access it if you're wealthy. And so if I, as an American, if I want to pay a Nigerian graphic designer for work, and we're going through our banking systems, Nigeria can really determine what currency they receive their money in, because they control the ports of entry and they control the bank wires. So I could pay them in dollars, but it might hit their bank account in their local currency, which is devaluing and generally negative real interest rates, and just it's hard to save in it. And if instead they want dollars or they want Bitcoin, now there's ways with Bitcoin and stablecoin to go around that. She can hold up a QR code on a call just like this, and I can pay her around the banking system. Or she can send me a DM or an email, some sort of just string of numbers saying where to send the payment to. And it can either be fully decentralized if she's kind of a power user, Or a foreign hub, let's say a stable coin in Switzerland, could offer this service. This is okay, it's centralized, but the central hub is not in Nigeria. And so it's basically like an offshore bank account for the masses, for the middle class, rather than just the wealthy. So depending on what level of decentralization or scarcity you're looking for, there's multiple options here. But the point is, there's competition between monies at a global level. The kind of the blood-brain barrier around these monopolies is slowly made more and more porous, just because you can circumvent that. You can memorize 12 words and bring $10 million worth of stable coins or Bitcoin with you through an airport. So when you see the sign that says only $10,000 allowed, you kind of chuckle to yourself, because you think, I mean, that's based on the premise that you can prove that someone doesn't have this other type of asset. It's just an antiquated analog world. So I think that that's probably the biggest factor, is that it creates more competition of money and more, I guess, more broadly liquid assets. So even things like a tokenized treasury bill, for example, but just kind of liquid assets in general now have more global competition, because they can pierce through these different borders way more easily than they could pre Bitcoin and pre this space. I think that's probably and that that starts small, but once the liquidity's big and once adoption's big and once it's normalized and once it's widely understood, that's disruptive. That kind of that can disrupt who has power, because if you're a government and you benefit from seigniorage, and let's say you're an authoritarian country and you make deals with the IMF, so you get all these kind of hard currency loans in dollars, and your people are kind of stuck in the local currency, you can keep printing more of and devaluing and siphoning their savings and devaluing their wages and funneling it to whatever you want to funnel it to. That starts to get disrupted, because those people can start saving in other types of money that is not that centralized local money, and then that kind of more quickly depowers those people that are kind of constantly siphoning that money towards the top.
Dollar hegemony will surely end, but not in the foreseeable future. Most of the world has no prospect of an alternative to the international dollar to be used at scale in the next 2 decades. Lyn Alden emphasizes that despite 160 local currency monopolies, global competition has always existed. The dominance of currencies like network effects and monetary premiums drives the US dollar. According to the latest Bank of International Settlements survey, the dollar accounted for one side of 88% of all daily global trade. Meanwhile, International Monetary Fund data shows it accounted for around 55% of all central bank reserves in the third quarter of 2023, far more than any other foreign currency. Alden notes the U.S. faces ongoing trade deficits due to global dollar demand. This creates a cycle where countries accumulate dollar reserves, boosting the dollar's value while worsening trade imbalances for the U.S. by reducing export competitiveness. Now let's redirect our attention to a video.
Going back to my prior point, there's 160 different currencies. They can enforce local monopolies, but on the international scale, they've always had competition,
Yes.
right? So why do I decide to hold dollars if I'm in country XYZ rather than hold, kind of yen, for example? It's partially because of that global competition, that network effect. So back in the day, that common unit was gold. That was kind of the underlying. And as speed became more and more of a variable, we started to abstract that. So, for example, the British currency was, it was a layer 2 on top of gold, but it was basically this faster clearing, centralized clearinghouse type of thing that entities could, whether large banks or central banks or other kind of large entities, could all kind of go through this efficient clearinghouse to store value, transfer value. And of course, after World War II, that shifted increasingly over to the United States. And what's different about this era is that the dollar is free floating. All currencies are. They're not tied to gold anymore, even though central banks still use gold as kind of long-term collateral. But basically, these currencies are free floating. And whenever there is a money that is the network effect dominant money good. So it's the one that most people want to hold. It's the one with the most liquidity. It's the one where the most people are storing their savings in it. They give a monetary premium to it, meaning that they're putting more emphasis on that than just its utility value. So in a world where there's a bunch of commodity monies and people realize that gold is the hardest one to debase, so they store their money in gold, that overall kind of gold market cap increases quite a bit because it's not just the utility value of gold, it's the whole monetary savings as well. And on the global fiat currency stage, a typical currency like, Egypt's currency, there's not really any external forces saving a lot of value in Egyptian currency. So Egyptian currency is kind of trading at its like equilibrium value. It's like utility value. Whereas a lot of countries around the world and a lot of even people around the world at the black market street physical currency level want to store their value in dollars. And so that they give a monetary premium to dollars above their utility value. And so a lot of currencies trade, real interest rates. That's a big factor that kind of makes more entities want to hold it or less hold it. Another big factor is how good the economy is doing and what's the current account surplus or trade surplus look like. If they're producing more than they're consuming, that's generally good for a currency. These are all things that affect like a utility value of a currency. What makes the reserve currency, in this case the dollar, different is that regardless of what real interest rates are doing, for the most part, regardless of what the trade balance is doing, simply because it's the network effect dominant good. It's what debt's priced in. It's what international contracts are made in. It's the largest, most liquid capital market. So many people are holding that currency or that currency's derivatives. And what that's doing is that even as a trade deficit develops, it doesn't really get corrected in a way that many other currencies would. And so, the whole world demands dollars. And so the question is, how do those dollars get out to the world? If all these countries are holding dollar surpluses, if they're all denominating their contracts in dollars, or at least a lot of them are, how do those dollars get out there? And the answer is structural trade deficits. They hold dollars so much that they increase the value of them. And then the United States finds itself saying, okay, well, it's very expensive to make things here, especially low margin manufactured goods. It's very expensive to make things here. Our labor is expensive. Our whole supply chains become expensive. So we have increased import power because we're the currency with the extra monetary premium on top of it. But our export competitiveness is weaker. And so we kind of build structurally these trade deficits.
Fiat currencies are government-issued legal tender not backed by a physical commodity like gold or silver. Instead, their value is derived from people's trust and confidence in the stability of the issuing government and its economy. Central banks are responsible for issuing and regulating fiat currencies. In contrast, the crypto world operates outside traditional banking systems, free from such regulation, offering an alternative. Can crypto manage to replace the USD as the next global reserve currency? Feel free to share your thoughts in the comments. If you found this content helpful, give it a thumbs up and remember to subscribe to stay updated. Thank you for being a part of this journey with us.